Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Shaun Richards from Not a Yes Man Economics, and we're going to talk about Portugal. And Portugal, as with Greece and Italy, I think probably has gone a bit off the radar, but it's important to keep it on the radar because there are probably issues still in place with Portugal. So
there are quite a lot of factors in play, and I want to say before I start this, I like Portugal a lot, actually. Lovely country, nice place to go. There's become, though, the last week or so, a theme coming from the upgrade from S&P late Friday night. It came out with various things that I question. I mean, and actually, it's not just me questioning it. If you look at the data, there's problems. And I know that places like the Financial Times and that have repeated a thing. So let's go back to basics. Has there been some improvement in Portugal? Yes. For example, the fall in the unemployment number.
It's still very high, though, isn't it?
Yeah, but 9%. However, from where it was, it's quite a lot lower. Now, they went further, though, however, to sort of assert that it's not only export growth, but exports are going to surge forwards in the future. It's a fantastic idea. Economists are never happier than discussing export-led growth. However, if you actually go and look at the data, as I did, things started to turn around about this time last year, perhaps last summer, and I mean last 2016 summer this, where in fact import growth went a lot faster. Now, if you look at Portugal over time, as I've done, and you followed it, that's very disturbing. There's a reason that Portugal's gone to the IMF so many times over the years, and it's that one.
It's the balance.
Yes, so there is a clear concern. When the economy picks up, goes too fast, imports too much, trade gets out of control, it then needs help again, growth isn't very much. And then when you look back over a period of time, decades, and quite a few decades you can look back now, you find that growth at best is about 1% per annum. So this is the problem here, that the sort of, if I may put it this way, the cheerleading over the last week forgets the fact that actually this could be the same old pattern. I hope it's not, but it quite easily could be, and through the data it looks very much like that.
And we've got a stronger euro as well.
This is another issue, that the fact of, exporting with a higher currency, we'll see how that goes for them, because particularly in many of the things that they do are price competitive. They've also announced raises to the national minimum wage and that sort of thing, and then that's obviously in itself a nice thing, but if you make progress by internal devaluation, otherwise known as lower wages, then you raise them, again, there's questions here. And if we skip to the other side of the coin, which is the market impact, well done to anyone who's been long Portuguese bonds. They've surged, yields have gone a lot lower, well played. But taking that as an economic signal is very dangerous these days when the European Central Bank has bought so many of them.
Exactly.
Owed so many in the past from the securities markets program, now buying again. Often reports that it's underbuying it. Well, one of the reasons it's underbuying is it bought so many before. It's rattling up as to how many it could hold. And of course, at that point, we then need to wonder what the bond yield's actually telling us. With the biggest, largest purchaser being the ECB, where things have changed, it would presumably buy more. So there is quite a few questions there, and not what's being pushed out this week, I think. Nice to see it doing well, but it could be the same old song.
Understood. Well, you heard it here first. Look out, Portugal. Shaun, thank you very much for joining us today.